Welcome back to the channel. If you're new here, don't forget to hit that subscribe button and ring the notification bell so you never miss an update. Today, we're diving into a topic that's absolutely crucial for any Forex trader. Risk management. Trading Forex can be incredibly rewarding, but it's also a high-risk game. Without proper risk management, you might find yourself losing more than you win. But don't worry. By the end of this video, you'll learn how to protect your capital like a pro. First, let's talk about why risk management is so important in Forex trading. When you enter the market, you're not just competing against other traders, you're up against global financial institutions and professional investors. These entities have deep pockets and extensive experience. Without a solid risk management plan, you're gambling with your money, and the odds are stacked against you. Remember, it's not about how much you can make, but how much you can protect. The key to long-term success is preserving your capital. So how do you set up a solid risk management plan? It all starts with defining your risk parameters. The most common approach is the 1% rule. This means you should never risk more than 1% of your trading account on a single trade. Let's say you have a $10,000 account. This means you shouldn't risk more than $100 on a single trade. This might seem conservative, but it's a strategy that helps you survive losing streaks and keeps your emotions in check. Another essential tool in your risk management arsenal is the stop-loss order. A stop-loss order automatically closes your position when the market moves against you by a certain amount. This prevents you from losing more than you're willing to risk. For example, if you set your stop-loss at 50 pips, and the market moves against you by 50 pips, your position will close automatically, capping your loss. Using stop-loss orders isn't just a good practice, it's a necessity. It takes the emotion out of your trading and ensures you stick to your plan. Now let's talk about position sizing. This is where many traders go wrong. Position sizing is about determining how much of your capital to allocate to each trade based on your risk tolerance and the stop-loss distance. Here's a simple formula. Risk per trade, account balance, risk percentage position size, risk per trade, stop-loss distance. For example, if you have a $10,000